Have you ever felt like accounting is some kind of secret code? Well, today, we're going to crack it. We're talking about the secret grammar of accounting, the absolute foundation that once you get it makes everything else just click into place.
So you look at a transaction and the big question always is debit or credit? It can feel like a total puzzle, right? A debit goes here, a credit goes there. It seems so complicated, but I'm going to let you in on a little secret. This isn't about being a math genius.
You see, the real secret is that accounting is a language. And just like any language, it has rules, it has grammar. And once you learn the 3 basic sentence structures, or in this case, the 3 types of accounts, you've pretty much cracked the entire code. It all boils down to knowing how to classify things.
So here's our game plan. We're going to dive into personal accounts, that's the who, then real accounts, the what, and finally, nominal accounts, the why. After that, we'll tie it all together with the 3 golden rules, and then, you guessed it, a quick quiz to lock it all in.
These 3, right here, they are the building blocks for absolutely everything in accounting. Seriously, every single transaction you will ever see is just a mix of these 3 accounts. So let's jump right in with the first one, personal accounts.
All right, first up, personal accounts. Just like the name says, this is all about keeping track of the people and the other companies your business deals with. Think of it this way, it's how you know who owes you money and who you owe money to.
So, to put it simply, if a transaction involves another person, a supplier, a customer, or even a bank, you are definitely dealing with a personal account.
And we can even break this down a bit more. First, you've got natural persons, which is just a fancy way of saying individual people, like a customer named Ramesh. Then there are artificial persons. These are legal entities like a company or the state bank. And finally, you have representative accounts, which kind of stand in for a person or group, like an account for salaries that are due to your employees.
And this brings us to our very first golden rule. You're going to want to remember this one. It's so simple, but so powerful. For any personal account, you always debit the receiver and credit the giver.
Let's see how that works in the real world. Say, your business pays a salary of 10,000 rupees to an employee, Ramesh. Okay, who is the receiver of the money? Ramesh is. So we debit his account. Simple. What did the business give away? It gave cash, so we credit the cash account. See? Debit the receiver, credit the giver. It just works.
Okay, on to our second category, real accounts. This is all about the actual stuff, the assets and property that a business owns. Basically, if you can own it, it's a real account.
So we're talking about everything from the cash in the register to the computers on the desks, the building you're in, and even things you can't physically touch but that have value, like a brand name or a patent.
Now, real accounts come in 2 flavors. You have your tangible assets, that's the stuff you can literally see and touch, like cash, furniture, or machinery. Then you have intangible assets. You can't touch them, but they're still incredibly valuable. Think about a company's reputation or goodwill or a patent. And this brings us to our second golden rule, which is all about the flow of these assets. It's super intuitive. Debit what comes in to the business and credit what goes out.
Let's try an example. Your business buys a new desk for 20,000 rupees in cash. So, what came in? The furniture did. So we debit the furniture account. What went out? Cold hard cash. So we credit the cash account. Debit what comes in, credit what goes out. Easy, right? And that brings us to our third and final type of account, nominal accounts. Now, if the other accounts were about who you deal with and what you own, this one is all about measuring how well your business is actually doing. Yep, nominal accounts are where you track all your day-to-day expenses, all your income, any gains, and any losses. They're temporary, and at the end of the year, you tally them all up to figure out that all-important number. Did you make a profit or a loss?
So we're talking about things like rent and salaries. Those are your expenses. And then you have your income, like interest you've earned or a commission you received. This is really the financial pulse of the company. And here's our third and final golden rule. And honestly, this one just makes perfect sense. You debit all of your expenses and losses, and you credit all of your incomes and gains. This is how you weigh the money going out against the money coming in.
Let's do one last example. The business pays 5,000 rupees for office rent. Okay, what is rent? It's an expense. And what's the rule? Debit all expenses. So we debit the rent account. Now, what went out of the business? Cash. And what's the rule for assets going out? You credit what goes out. So we credit the cash account. See how those rules start working together? It's pretty cool.
So there you have it, the 3 types of accounts and their 3 simple rules. Now let's put it all together on one screen so you can see the complete picture.
And here it is, your complete accounting cheat sheet. For personal accounts, dealing with people, you debit the receiver, credit the giver. For real accounts, dealing with property, you debit what comes in, credit what goes out. And for nominal accounts, measuring performance, you debit all expenses and losses and credit all incomes and gains. That's it. That is the entire system. Okay, you've got the rules. Time for a quick pop quiz to see if it's all sinking in. Take a look at these 4 accounts. Can you classify each one as personal, real, or nominal? Go ahead. Pause for a second if you need to. So how'd you do? Let's check. Cash is a tangible asset you own, so it's a real account. Salary is an expense, which means it's nominal. The bank is an artificial person, so that's a personal account. And goodwill is that asset you can't touch, so it's an intangible, real account. If you got those right, you are well on your way.
So what's the biggest takeaway from all this? It's that you now know the fundamental grammar of accounting. It's not just about crunching numbers. It's the language that tells the financial story of any business. The only question left is, now that you can read the language, what stories will you be able to write?